the G6 haven't had an easy day at the market today. The bond yields have slumped largely because of reports that JPMorgan has once again decided to leave India out of its emerging market bond index. Well, what does this really mean and how does this impact Indian bond market? Hello and welcome to yet another episode of BL Explainer series, and I'm Hamsini Karthik. Before we go any further, let's understand what global bond indices are in the first place. You've heard of the MSCI index, right? It's one of the most popular global equity indices. Now, what does it really do? It tracks large caps, mid caps, and small cap stocks from across the world. And the index helps investors make an informed decision on where to invest and what kind of stocks to invest in. So for big global investors, tracking each of these markets individually may not be practical or possible, and hence inclusion in global indices helps investors take an informed decision. So being part of the index also helps stocks and the country attract investors' attention. Simply put, if a country is part of the index, its stocks could get better visibility, and in turn, this will boost investors' participation into the stock market and also help generate liquidity for the stocks and for the country itself. So basically, every country wants to be a part of this inclusive list. Now, a bond index is also very similar, but here, what is traded are bonds and not equities. And there are two large bond indices which are globally popular. One is the JPMorgan index, and the other one is Bloomberg Barclays index. There are some guiding principles which every country goes through in the selection process. The most important of all being the size of the market, the country's rating, and the ease of access to capital. Investors always look to get best returns for their money. Therefore, they prefer stocks or bonds of certain quality. And here's where transparency, liquidity, ease, and safety of transacting plays a very important role. If a country allows for easy repatriation of money without imposing a lot of taxes, or if it helps squaring off trades without insisting on local settlement, that too will help make the cut. India has a bond market, but the country has been trying to be part of the index since 2013, but Indian bonds haven't really had success. There are two factors which have really played against the country. One are the tax laws, and two are the factors with respect to settlement of trade. India, we impose something called as capital gains tax, wherein we tax the gains from equities and bonds as well. Now, long-term capital gains is subject to 20% taxes, while short-term capital gains is subjected to 15% taxes. Right now, these tax structures are applicable to both domestic as well as foreign investors. The lobby of the foreign investors at play is that they get certain exemptions with respect to tax laws, and the government is unwilling to discriminate between the domestic and foreign investors. Secondly, India wants local settlement of its government security. Note, China had also insisted on this, and China has had it its way, which is why India has a strong case to insist for local settlement of G6. But right now, the practice is that all bonds listed in these global indices will be settled by the Euroclear Bank, which is where all the bonds, irrespective of the origin or the country, go through for settlement. But then, what really does an inclusion in the global index hold for India? It comes with a lot of benefits. For instance, investors could pump in nearly 30 billion US dollars into the Indian bond market within the next 10 months, says a report by JPMorgan Stanley. In fact, the brokerage expects that an inflow of as much as 170 to 250 billion dollars is likely over the next decade. Another report by JPMorgan says that foreign ownership in G6 may jump up to 10%. Right now, foreign ownership in government securities is a little less than 2%. Now, that is exactly the reason why India is keen to participate in these global bond indices. There's one more objective that will get realized. For a very long time, India has been trying to push its large corporate to borrow from the bond market. However, there isn't so much depth in the bond market just yet for corporates to make the shift from bank funding to bond funding. An inclusion into such a global index will ensure that that objective is also met. However, an inclusion has its own risks. For instance, once a bond is on the global platform, it will be subject to the risk of volatility in terms of its own pricing as well as the currency risk.